I am an ag finance specialist with North Dakota State University, which basically means if it's not crop marketing or livestock marketing, I wind up dealing with a lot of it. So I give a lot of talks on land prices, both at the state, regional, and even at the national level, and track a lot of the data and stuff that's going on with it. And one of the things that is important as far as land prices goes is what's going on with, and we don't have a ton of time with these, so I'm giving you guys the fire hose, basically effect of what's going on with land prices. One of the things that actually impacts land prices are interest rates, all right? Basically terms of financing. And there's two ways that interest rates tend to have an impact, one of which is just, obviously, if you're going to borrow money to purchase, the amount of interest you're going to pay is, impacted by the rate as well as your down payment and everything else. And then the other part of it is, the one that most folks don't talk too much about, is other investment options, right? The higher the rate goes, the higher those other investment options are. And folks will talk about, well, if producers don't care as much about that because, land acquisition, the growth of their operation is more important. But who does care about that is investors, right? And a lot of times when it comes to land purchases, investors are kind of, blamed, or that prices are going up because of them. And most of the investors that I know, that I will tell you, they're looking for a deal. They're typically not the ones who drive the price up, because they have a rate of return that they want. If it doesn't hit it, they walk away and go to the next auction. The prices getting driven up are typically by other farmers in the area who've always wanted that piece of ground, and it comes up for auction once every 50 years and you're going to buy it. And that's what does it. It's not typically the investors. But I will say, if you even assume that 10 to 15%, it's right in that range, are investor purchases, and all of a sudden the rates of returns in other assets such as bonds and everything else are 5, 6, maybe 7%, and the rate of return on farm ground is so much lower, you take 10% of the purchasers out of the market and it has an impact. I guess that's where I'm going with that. That's along with and so the federal funds rate, though, which gets a lot of the news, the Fed, we all talking about it. You hear Jerome Powell's going to be replaced in the coming months as the Fed chairman. Those typically impact short-term rates, though. Those would be like operating loans, things like that. Longer-term rates are typically impacted by the balance sheet, the Federal Reserve's balance sheet. Those would be your 10-year notes, or more like land loans and things like that. And the balance sheet hasn't been discussed nearly as much as the federal funds rate has. And one of the things that happened with the Federal Reserve's balance sheet was, after the COVID pandemic, in order to spur on the economy, the Federal Reserve bought, you can see from the chart there, astronomically high number of securities, namely treasuries and mortgage-backed securities, to bring interest rates down and spur on the economy, to the tune of going from about $6 trillion to $9 in a matter of months, just a few months. You can see it, right? The big spike. Now, if you go back a little ways, you can see back there where that's the little gray bar there. That was the Great Recession, we called it, 2008, 2009. I know some folks in here aren't that old, but you were alive during that, right? Anyway, that was a historic round of purchases by the Federal Reserve in mortgage-backed securities and everything else to spur on the economy. And you can see how small it is compared to what happened just 10 years later. And that would be right there, over to there. All right. But pretty much the purchases peaked at about 9 trillion. Then the Federal Reserve started a sell-off of those, or they didn't really sell them off. They just stopped renewing, to make a long story short. And so then what wound up happening was that brings up those longer term rates. Long story short, the federal funds rate, I'll put this in a nutshell, can fall while longer term rates go up. There's a whole lot of other factors that go into that, but that's one thing to consider when we're talking about interest rates, their impact on land purchases, and the actions that the Fed takes. There's a lot of moving parts that goes into that, but only 1 or 2 of them actually make the news. And that's why that stuff can happen. So when we talk about interest rates real quick, this is from the 9th Federal Reserve District. That's us. That's the Federal Reserve Bank out of Minneapolis. It covers Minnesota, North Dakota, Montana, Wisconsin, and I think that's it. Yeah. Part of Michigan, a little bit. And so they do these surveys every quarter on interest rates within their district. They're surveying lenders is who's being surveyed. And we don't have the fourth quarter information yet from last year, but you can see from the chart up here, we've basically come down 1 percentage point since 2023 on every major loan category. Land loans, the real estate loans have come down from about, 7.9% to 7.1% in about 2 years. Fixed rates, that is. Machinery, down from 8.3 to 7.5, and operating notes from about 8.8%, the high during the fall of 2023, down to 7.7 as of the most recent survey. Now, I expect that when this survey is completed for quarter 4, it's probably going to be a little bit lower, probably maybe 10 basis points or 1/10 of 1% or so, but probably not dramatic. And very few people actually take the time to read the minutes from the Federal Reserve's meetings. I actually do. And it doesn't sound like there's going to be a big appetite for any rate cuts going into this year. It's going to be a wait and see, but unless something changes, pretty dramatic, some data comes out, maybe unemployment suddenly spikes really high or something like that, it doesn't sound like there's going to be anything on the immediate horizon. I never say never. I've been wrong too many times to do that, but so I'll hedge it with probably not, most likely not, in my opinion. So I want to go through some stuff real quick from U of M's FinBin data set, which also applies to North Dakota in discussing land prices. So this is what land prices have done in North Dakota since 2012. Okay, so everybody remembers the big run-up in, or high commodity prices and the big run-up in the price of land from 2006. Well, it started in 2006, but all the way until about 2012, 2013, and then things tapered off. And you can see if my chart here went back further, you would see the big slope. And so then what did land prices do in North Dakota from about 2014 to 2020? Correct answer is nothing. Stayed flat and just went sideways all the way across, right? This is adjusted for inflation, by the way. So I do an inflation adjusted for the real increase in land prices. But since 2021, cropland in North Dakota is up 46%. That is a big jump in a short period of time. And when I was putting this together, I was trying to compare 2024 and 2025. I figured we might see a 4, maybe 5% increase in farmland last year, 10.5. So I guess I was half right or half wrong. I don't know, or missed the mark by quite a bit. But I was surprised to see land prices go up that much last summer, considering the years we were coming off of, for it to be a 10.5% increase. That did surprise me. On the rent side, they have also come up since 2021 in North Dakota, almost 20%, and last year up about 4.25%. But 20% is not 46%, right? So we're seeing a big increase in land prices, massive really, and a more modest increase in rental rates across the state. Okay, so rents have gone up, and they even went up during that period I was talking about before, but not nearly as fast. Okay, and pretty much North Dakota, I just put this in there to show that North Dakota is essentially following the national trend. I mean, I always think of it like the ripples in the pond impact. Whatever happens in Iowa, we tend to be about a year behind. If land prices shoot up in Iowa one year, North Dakota tends to be the next year. The following year is when it happens here. At least that's what the data has been showing. That we're like a year behind, but the same thing winds up happening. So the national trends, North Dakota land prices are pretty much following the national trends. And one of the things we've seen happening is the inflation-adjusted assets have increased to the level above where they were in the 1980s. So essentially, asset prices, this would mainly include equipment and land, have increased even when you account for inflation above the 1980s levels, which is pretty surprising. And it's really just happened in the last couple of years that's occurred, primarily driven by the growth in land prices. But equipment's not nothing. I mean, a couple of years ago, we saw a huge increase in equipment prices as well. So that's feeding into this to a degree. But non-real estate assets are those little yellow bars at the bottom. So it moves the needle, but not a lot, right? It's mostly driven by land prices. And then cropland rental rates have done essentially the same thing. Okay, they nationally. They've gone up. They went up in 08 to 2013, flattened out, and then in the last 4 years, we've seen national cash rental rates increase, but at a pretty modest pace, at a similar rate that we've seen here in North Dakota. So this is a slide I always like to get to. And this is the top chart, are inflation adjusted in 2024 dollars, rental rates and land prices in North Dakota. The red line is inflation adjusted rent, and the blue line on the top chart is the inflation adjusted land price. Okay. So what you'll notice is from about 1989 through about 2006, land prices did a whole lot of what? Nothing. When you account for inflation, they might have even dropped slightly. Okay. So the real growth was small. Same thing with rental rates for the most part, either flat or slightly declining. And then in 2006, 2007, we saw a huge increase in both, but land prices increased faster, much faster. All right. And then you go past that 2014 timeframe through 2020, right after the pandemic period. And land prices stayed flat from about 14 to 20. Now, first of all, everybody remember what happened in that 2006, 2007 period that drove up land prices. You remember the EISA mandate, Energy Independence and Securities Acts? Basically, one word, ethanol. Drove corn prices really high, soybeans, everything else came with it. Commodity prices shot through the roof, fertilizer prices were extremely high, drove everything up. So that's that 08 to 12, 13 period. Then most recently, we had the high prices in, I wouldn't call them high in 21, but strong. And then, of course, 2022 was the highest net farm income on record, even accounting for inflation. So that's had a big role in it. And we saw land prices shoot up. Now, I want to direct your attention to the chart on the bottom. That is the cash rental rate divided by the market price of farmland. I call it a rent to value. It's not a cap rate for those of you in the audience who may be thinking that way, because I don't deduct a management fee or any kind of property tax or ad valorem from it. It's strictly just rent divided by values. In 1989, rents were about 9% of the value of farmland. Okay, so if land was $1,000 an acre, your rent was $90. By 2008, 2007, that had dropped to 5%. And the most recent calculation I did, it's 2.3%. So that same $1,000 an acre today would rent for $23. So that rental rate compared to farmland prices has absolutely just plummeted. And it's not because, again, rents didn't go down. Quite the contrary, they went up, but not nearly as fast as land prices did. And this is from our own data set within North Dakota's, from the Center for Farm Financial Management at U of M. And this only goes back to 2004, but I have it pretty much memorized, and I've seen the data going back to 95. The average farm size in North Dakota within this data set in 95 was around 1,000 acres, plus or minus. The amount of acres owned was 500, and the amount of acres rented, either share or cash, was about also 500, 5 to 6. If you look at the most recent data for 2024, the average farm size is just north of 2,200 acres, 2,300 acres, and still right around 500 acres is owned. Okay, same number of acres owned, so really we went from about 50% ownership in 95 to less than 25% total ownership in 2025, 30 years. You might ask, well, is that a bad thing? Well, from an equity standpoint, it could be, from the fact that you're renting a lot of your productivity. But I would ask, if I can rent something for 2.3% of what I can buy it for, and given what equipment prices have done, that's not that tough of a decision, really. So financially, it actually makes perfect sense. Whether people were making that decision because they had to or for that reason doesn't really matter. The fact of the matter is that at 2.3% of the ownership fee, possibly less, it makes some sense. Now, I do understand of the equity build and everything else. But when you were dealing with what happened with equipment costs, especially like the last couple of years, and especially with our like newer and beginning farmers, or we call them maybe capital constrained folks, and that's the best way I can put it, I suppose, capital constrained. And you're making a decision between, you want to grow, I can either buy land or equipment. There's only really one decision to make. So here, I wanted to show this real quick and what's gone on. This is our net cash income. This is within the whole data set. So this would be across Minnesota and North Dakota. There's some Illinois data in there, a little bit of Nebraska here and there, South Dakota, but mostly it's Minnesota and North Dakota by and large. And that's net cash income, inflation adjusted since 2000. So across all the way. And you see the big increase in 2010, 11, and 12. That shouldn't be surprising. Those were tremendous years. Actually, before 2022, 2012 was the best year on record in North Dakota. And then with this chart, I show our net farm income to gross farm income ratio. Okay, I'm just taking net farm divided by your gross. So of price quantity, how much of that are we actually taking home? Pretty easy ratio to understand. And when you take that ratio into account, 2022 and 21 were not quite as good as that 2012, 2013 period. Big reason for that being the costs. What happened with production costs during that period? High fertilizer prices. Fertilizer prices were high in 2013 or 2011 and 2012 too, but we didn't have, anhydrous at $1,200 a ton and urea approaching $1,000 a ton during that period of time either. But you see those ratios, and I want to direct your attention to 2007. There's a pretty big peak there. Now, if I were to go, I think I can go backwards. I cannot go backwards. Yes, I can. Red button. 2007 was basically an unremarkable year net income. Really, I mean, it was decent. It's a little spike. You kind of see it right before the run up there, but it was kind of unremarkable. And yet, in net income to gross was a very strong year. Why is that? Because our production costs hadn't caught up to what commodity prices were doing yet. Okay. So then I like to look at this. And this is one of the things that I'm kind of concerned about related to land prices and things moving forward. This is rate of return on assets and equity and through the FinBin data set. Rate of return on equity is red, rate of return on assets is blue. And I pointed out 2007 for a reason. If you look at 2007, it was a decent year, but the rate of return on equity that year was 16% and rate of return on assets closer to about 12. In the 2009, 10, 11, 12, that strong little cycle that we had there, rates of returns on equity was actually north of 16%, approaching 17%, and the rate of return on equity over 12% in some of those years. Now we look at 21, 22. 22 was the highest net farm income on record, as we said before, right? Why is the rate of return on assets and equity so low compared to the previous cycle? Land and equipment costs. Mainly land. Equipment's only 8%. It's actually mainly land prices. In other words, land prices have grown faster than incomes, accounting for inflation. Significantly faster than incomes. And you look at 2017, 2018, those were not particularly strong years. In fact, 2024 was significantly better, and yet the rate of returns on assets and equity was about the same during that period of time. So what has happened? Equipment, mainly land prices have dramatically increased to the point that we have to earn even more to achieve the same rates of returns we achieved 15 years ago on those assets. So you might wonder, well, what's the solution for that? Well, what if we increase incomes dramatically? What do you think will happen? Land prices. Hint, they're going to go up with them. So that's not really going to change anything. In fact, I would argue if it went to the point, if commodity prices and everything else went to the point that we were getting a 16 and 17% rate of return like we did in 2010, 11, and 12, we would take the top off of land prices most likely if that were to happen. And then the flip side, I'm not even going to mention the other side. I'm not even bring that up here, but obviously a downward movement in land prices would adjust these numbers up significantly. And then when we look at the debt portion of things, we're seeing as much inflation adjusted debt on that side in ag as we saw in the late 70s, early 80s. And that's a cause for concern if interest rates are going to stay higher, especially in a period where there may be some folks who are needing to do some restructure and things like that. And if you're taking out new loans at a higher interest rate, that's a challenge. One of the things that's helped with land prices recently is that a lot of the financing was done when interest rates were, significantly lower, right? 3-4% at times. That was achievable. And so I'm going to finish off with this real quick. It's basically the income approach to appraisal. When I talked to the American Society of Farm Managers and Rural Appraisers last week, and one of their continuing ed things talking about this. But there's really three fundamental components to the income approach to appraising land. You've got the profit you're going to make, reversion expectation, which is a fancy way of saying resale or capital gain kind of deal, and then the terms of financing, like I talked about on the interest rate side, loan to value, that kind of stuff. All right. So let's do a quick exercise using earnings multiples. And I made two ratios out of this. Market value of equity, that's basically farmland prices over revenues generated. Okay, that's the bottom, so that's going to be our price to sales ratio. And then the margin, which is your net income divided by the cost of production. Not any fancy math here, just a couple of simple ratios. And if you look at the block, and I know that's probably really hard to see with the arrows, but we had a period from 1960 to 75 where we had a high margin and a relatively low price to sales ratio. So what wound up happening was farmland prices went up because we had high margins and the price of farmland compared to the income it was generating was low. Okay. So then you move into the 1970s and you had a period early there where that price to sales ratio actually doubled. So prices of farmland went up, but the margin stayed fairly high, and that was okay. You can exist in an environment where the price of the asset is high, but you're making a lot of money with it, right? That makes perfect sense. So then we roll into the late 70s, early 80s. Our price to sales ratio had doubled again all the way up to 8, but our margin dropped to 12%. Can't exist in that environment, not very long. Can't have a high price of an asset and very low margin. Doesn't make financial sense. So we all know what happened after that. Land prices went down 50% in 2 years, and it took a better part of 20 years to recover the lost equity when you account for inflation. But we pretty much went into a stable period from 1985, 86, all the way through the late 90s, early 2000s, where the margins stayed pretty consistent, land prices stayed pretty steady, and you can exist in that environment forever. So let's fast forward to where we are today and looking at this scenario. So if you look in the middle of the chart where that blue line really dips far, that's the 80s where margin went real low. And then the red spike was the high price to sales ratio. It went down because the price of land went down, not because sales went up. And then we existed in that pretty stable environment, like I said, from the late 80s all the way through the early 2000s. High margins in 2006, 2007 prompted the price of farmland to go up dramatically. So that price to sales ratio went up. And then we hung out in that 20 to 25% margin period for the better part of 10 to 15 years. We're still in roughly a 25% margin period, 20, but our price to sales ratio has actually gone up over 20 to 22. So what's wound up happening is that market value of farmland assets has grown and outpaced any kind of margin gains, is essentially what's going on there. So the question then is, so what? So what's going to happen? That's the next question I get. And the honest answer is, I'm not entirely sure. I've been dubious on this for a few years, but I continue, like I said, with when I started, to be surprised with the resilience in farmland values, given where we're at in this. I guess I would say my best prediction, and this is kind of a soft one, is I think we're going to start to see in the next few years a tapering off. I don't think it's any kind of a doomsday scenario coming or anything like that, especially because of the way that assets have been financed over the years. The differences between the 1980s versus today, very different. In they weren't allowing folks to increase their asset values, then using that as collateral to buy the next piece of ground. That stuff wasn't happening, right? And that's a good thing, because that's also going to put a nice stability on it. But I can see a scenario where over the next 10 years, kind of like the ones I showed in the past, land prices flatten. They just kind of sit there and hang out. Maybe rents move up at the rate of inflation, a couple of percentage points at most year over year, and it closes that It would do a couple of things. It would improve the price to sales, assuming that our incomes continue to increase at the rate of inflation. Rents do. It would make that rent to value make a bit more sense given where farmland prices are and our incomes are, and it would be basically the soft landing for where we're sitting right now. That's the best case. I'm not going to discuss the worst case. We don't have enough time, and I want stuff thrown at me. So you guys don't have any tomatoes, do you? But with that, I have just a couple of seconds or a couple of minutes for some questions, and then I got to yield the floor to one of my colleagues from the U of M. So any concerns? Like I said, this isn't a doom and gloom scenario. It's just something to think about as we're moving forward, that how high is this going to go, and do we want to get in on it at this point in time? You know, I can't answer those questions for you. I can just show you exactly kind of what's going on, and so we're all wide-eyed as we head in. Do we want to make this purchase or not? If so, go for it. And I understand. You know, I'll end it with a story. Like I'm originally from Nebraska. My family farms in the Southwest, and we raise cattle, and we rented this several section pasture in between two pastures that we owned. And we had this was several years ago, many years ago, 20, an option to buy it because the owner died, and we set a limit of $250 an acre is what we would pay, and it went to $400, and we paid that. And when on the way home, we asked, you know, why the limit was $250. You know, why did we go so high? And my grandfather said he couldn't stand the thought of his brother-in-law driving across it. So paid a lot for that. So just saying. That's a true story. Yes. His rent isn't keeping up with the inflation. That's a great question. And I've had a call from both the landlord on that and the tenant, asking, you know, my landlord wants to increase it with the rate of inflation, but commodity prices are low. I guess that changes things. I think that it's important for anyone who's negotiating leases with tenants to be aware of what's going on in the greater ag economy. It's always our goals if we're talking to landlords and tenants to, and I'll never use the word fair rent, because what's fair depends on who you ask, but one that's tenable, where the tenant's not being overburdened, but the landlord's being decently compensated for owning the asset. I mean, and so going up with the rate of inflation, that could be tough, because what if inflation's going like this, but commodity prices are going like that? And then what's the gap in there? That's why I've always been a big proponent of share agreements. That's really the easiest one to, because it self-adjusts for commodity prices, but most folks don't want to do share because it can be a challenge. So the next best thing I've always said are flex leases, you know, where you put in a floor, a cash rent floor, and then you have some sort of bonus beyond once costs and everything are covered. That way, if fingers crossed, beans or something goes up to $15, then the landlord gets a little kickback from it if that were to happen. But in that situation, I would probably try to sit down and discuss where the ag economy is at the current period of time, the financials, and show, you know, would that rent be able to cash flow for the tenant? And if not, then maybe another discussion should be had. I guess that's the most PC way I can cover it. But I'm out of time, thankfully. I'm turning it over to a colleague from U of M. Thank you.
Let's thank Dr. Parman.